Hey everybody, Boris, BK Forex. Welcome to the weekly technicals for the commodity dollars for Aussie dollar, for dollar CAD, Kiwi dollar, November 13th to November 17th, 2017. Commodity dollars remain a very low volatility trade. We're moving 50 points a week. It's more exciting to watch paint dry sometimes than to trade commodity dollars at this point. And nothing on the horizon looks to really change that dynamic. One of the ironies of the whole thing, by the way, ironically enough, is that even though the dollar is actually weaker against the majors, against the euro, against the pound, it's strengthening against the Aussie and the Kiwi because U.S. yields are rising. And that may be sort of the most interesting takeaway from last week's trade, that U.S. yields, despite not having much of an impact on the majors, are having a much bigger impact on the carry trade, because obviously as U.S. yields rise, the carry trade loses all of its luster, especially, and this is the critical thing, especially with the view that neither Australia nor New Zealand are going to raise rates at this point, probably all the way to 2019. Certainly not nowhere near in the next 6 months. So any kind of upward tick in U.S. rates makes the carry trade less and less attractive on a day-to-day basis. And that may be sort of, I think, the biggest takeaway as far as trading flows go going forward. We certainly don't have a lot on the calendar to kind of move things around, and we certainly don't have anything that's going to change that dynamic. That's really the critical thing. Nothing around us is going to change the dynamic except, of course, U.S. yields. So if U.S. yields start to collapse, these things come back. But until then, it really looks to be the Aussie Kiwi sell move as far as U.S. yields go. So let's take a look at the charts. Charts have compressed a lot. We're literally a 76, 77 trade in the Aussie. Canada is its own idiosyncratic story, of course, because we've got oil, we've got Saudi Arabia. This is a separate issue that I really want to discuss actually a little bit more. And Kiwi looking a little bit better bid. We still like the 68 support level here, but again, U.S. yields go above 250, maybe even 260. If we have a sort of a rally in U.S. yields, that support could get knocked out. So it's worthwhile watching the trade as we go forward. Nothing much on the calendar. I kind of covered the fact that we had Australia employment coming up in the major section. My apologies. I'll go over it again. But basically, when you look at the COM dollar set, there's really only just Australia data and just a tiny bit of New Zealand data. None of it really important. So New Zealand PPI might be mildly bullish Kiwi as we look at it. The Australian employment data, as I noted earlier, could be strong. We're certainly bullish on the numbers, but in the long run, not much of an impact, because what's troubling Australia is not the jobs numbers, but the wages and the overall decline in housing value, which is making the whole population poorer, which is making consumption much more problematic. And that is a much bigger problem, which is keeping rates stationary. And in fact, the RBA could be in a situation where they may have to be forced to lower rates rather than hike them. So nothing here suggests that we could have a major spike in both of these pairs. It's really going to be a function of this. Probably the single biggest indicator of where Aussie Kiwi go will be the 10-year U.S. yield. We see that closing, inching up towards into the 240s, closer to the 250s. Aussie Kiwi likely going to get punished further. Let's take a look at the charts just sort of on a basis. You see, so Aussie kind of very much failing at around the 77 level, ending on the lows. Really looks to me, actually, I mean, it's not a, it's obviously chop. So the true signal here would have to be to break at a 76s. That would be the classic technical signal to take. If we break the 76s, you have a much clearer trade all the way down to 75 support area. We've been just kind of stuck here, but certainly the failure at lower highs, failure here, definitely failure here, all of it suggests downward pressure on the Aussie as a function of, in many ways, the compression of the carry trade. As I said, nothing inherently on the Australian side is going to make the Aussie go up. So it's really not going to be essentially a function of where the U.S. yields are. And similar story on the Kiwi. Kiwi did have mildly bullish RBNZ, which then kind of unwound itself after the finance minister said, yeah, we're probably going to be a little bit more accommodative than we're used to. The dual mandate of the RBNZ is still something that that is holding like a sort of Damocles over the Kiwi. But on the other hand, if you look at it technically, there is just this massive support here in the Kiwi, simply because the Kiwi still offers the best, richest yield around, and that provides carry trade, buy to dip buyers continuously when we get down to this level. So you really need to have I think a significant move in the U.S. yields to break this dip. So any kind of a move down here, probably still a pretty decent buy here. Only if we break the 68 has the situation completely changed. Clearly, overall, it's a massive distributive head and shoulders, but it is, finding this double bottom support here, and it's by no means clear that we're going down. What does suggest here is we're consolidating at the bottom of the range here. If the U.S. story flips itself around, if we find ourselves 230, 225 end of next week on yields because of decline of faith in the U.S. economy, this thing comes right back up and actually becomes a buy to trade. And to me, the relative strength trade against the U.S. yields is the Kiwi, and that may be sort of the most interesting way to look at it. If U.S. yield starts to decline, I like the Kiwi the most as the potential to break out because it still offers the best carry in place. Now, CADJPY, its own story. CADJPY really is, let me just get rid of all this because it's just impossible at this point to kind of look at it cleanly. CADJPY is certainly subject to a little bit of this, although not much of an impact. Definitely trading better because oil has certainly firmed, and we've certainly come off this very, very CAD bearish trade structure on 29, right? So here you sort of have a kind of a failed breakout attempt at 29 that's not distributing to the downside. Decline in the dollar. I mean, to me, CADJPY actually looks also as a pretty decent relative strength. So I like CADJPY both. I like CADJPY and Kiwi against the Aussie in many ways. So my whole point is that in the commodity landscape, Aussie is the weakest. CADJPY and the Kiwi are probably the strongest of the two. Kiwi getting a lot of its juice from yields, so it'll be driven by yields. CAD getting a lot of its juice from obviously higher oil prices. And again, here this is a very, very tough handicap because it's a political handicap. We don't understand what's going on in Saudi Arabia. It is utterly unclear whether this is just sort of a regime change that actually may be oil negative or stability positive, or the beginning of something much more ominous where you could have massive disruptions in the region, which could push this thing to 70, 80 faster than we can blink an eye, based upon political fears. And then CADJPY becomes the bomb. CADJPY becomes, in fact, the only source of the source of stable oil there is. And that really puts a huge amount of positive pressure on the loonie, negative pressure on dollar CAD, and we could see 124 very quickly. As it stands now, 26 is the support area. We're in sort of this quiet range. But again, I think the calmness is deceptive because calmness is not contingent on the economic basis of Canada, but calmness is really contingent on the fact that we're just not getting a lot of spikes over here. If you look at oil itself, just because it's so important, so yes, we've spiked out here, this 58s, and if this is the distribution top, if the market really thinks, yeah, there's really not that much of a political risk anymore beyond this, that's it. CADJPY probably trades back up to 27, 28, but we start breaking out. We take out the 58s. It's a completely different story. I mean, oil actually as a trade looks extraordinarily bullish. We took out the highs. It's a consolidated move. We are not moving back. This is a very, very interesting point technically. Yes, while we may have distributed for 3 or 4 days, we stalled. We are not dipping back, and as long as we stay about the 56, the sellers just can't bring it down. That means there's accumulation here. This is not. Don't get lulled into thinking this is a top. This is just accumulation, and this accumulation, that means dollar CAD could be a move to 124 if oil goes to 60. So watch these two correlations because they are so extraordinarily important, and that they could be the key to movement next week. Wish you guys the best luck, the best of trading. Boris, over and out.